Thank you very much for joining us today. I'm going to start with some quotes. All green is all bankrupt. That's what it represents. If you don't get away from this green scam, your country is going to fail. That was, of course, Donald Trump at UNGA last week. And yet, clean energy investment hit $2 trillion globally for the first time last year. Presumably, some of that was influenced by the speakers on today's panel. So, Karen, let's start with you. What does the political backdrop, current political context, do to deal flow and the kinds of deals that are getting financed?
Sure. Thank you for having us today. When you think about that $2 trillion numbers, and I think it's important to think about the breakdown of the technology mix. And we all know renewable energy and storage is already making a very strong business case. So that is about 90% of the global new energy generation adds that we're seeing today. Because it does already reach pricing competitiveness, and it's cheaper, it's greener, healthier, why not? The rest is obviously kind of, when you think about the transmission, the grid upgrades, because there's a lot of waste in from generation to distribution. So we got to make the grids better and more efficient. We got to do predictive maintenance better. Money is going there because you need the transmission to transport the power. Electrified transport is also representing a huge amount of investment dollars. So when you think about that $2 trillion, which is a milestone, because we were just at about $1 trillion a few years ago. So the CAGR has been really great. But most of the investments are going to mature technologies that break even, that are pricing competitive. So we are incubating emerging technologies, but those are not more than 10% of the global investment. The other thing to think about is obviously, we talk about policy backdrop. Out of that number, 40% is China. Very strong industrial policy. You can argue the good or bad, of it, but they are about $800+ billion of that $2 trillion. US and EU 27 represents just under 35%. And the rest is obviously the rest of the world. So you can see policy, incentive, stability, clearly spur innovation, continuity of investments, because a lot of these are infrastructure investments. They take a long time to plan. They take a long time to permit. They take a long time to construct. And they have a useful life of, depending on the technology, 15 to 35 years. So these are long-term investments. If you can't plan for the horizon that you need your investment to be built and maintained for, it's difficult to make that bet. And the margins aren't significant enough to make all these bets regardless of the policy cycles. So I think, in short, where you see policy stability, strong industrial policy, and long-term support, you are seeing continued dollars with a lot of growth rate into those markets. In the US, I think in 2022, we saw the Inflation Reduction Act. We did see hundreds of billions of dollars of clean energy investments, and that continued to drive the supply and drive the cost down. But given the One Big Beautiful Bill and some restrictions and qualifications like foreign entity of concern, you had to clear these eligibility criteria to continue to benefit from the tax incentives. I think we're going to see some slowdown in the US renewable build out, for example. And that is just the reality we're facing today. And Mallika, I want to cut the sort of investment picture in a slightly different way, which is to talk around, obviously, big numbers going into clean energy, but we're also seeing significant continued investment in fossil fuel activities. And that ratio, my colleagues at BNEF look at that ratio quite closely, and it's not where we need to be for the world to be on track with any form of net zero target. And when you think about the next sort of 5-10 years, say, and where energy demand is, how do you think that ratio is going to evolve in terms of how people are looking at fossil fuel investment versus clean?
So yes, thank you again for having us here on this panel. So a slightly different perspective, obviously, because we are sort of an energy major, so looking at these opportunities. So I think one thing to put out there is that energy transition is happening. You can have a discussion about how quickly or not that might be going. So I think that investment in clean energy is going to keep increasing. Now that brings me to sort of what I worry about, which is what happens in that transition. You're moving from one type of energy system to a very differently configured, very different needs in terms of infrastructure, et cetera. And in that transition, you still do need to have the existing system providing that support as you decarbonize, to provide resilience, to make sure the lights stay on, et cetera. So you need the investment to be, or at least the fossil energy to be there to meet that need. And then the other thing we look at is, okay, what are the sort of production of fossil fuels today that we look at and we think, okay, what does the trajectory look like? And what's something that escapes a lot of people might be that all the existing fields have decline rates. So even if you didn't invest another dollar, you'd have declining production. And does that meet the need that you think that the energy transition to 2050, which is 25 years, do you have enough of the backup or that the traditional energy system will provide? So I think that to me is the issue. And that's where the real tough decisions are. What is the right level of investment? Where is the right level of investment in terms of what's going to be the last man standing on that, to provide those fossil molecules?
And does that underpin Shell's big investment in gas, this sort of situation that you
It's
saw?
part of the story. I mean, we have obviously the gas portfolio and the LNG, but we also have 20 billion in capital employed currently in low carbon. And again, we're testing it. We're trying to see what kind of returns and business models would we get on that 20 billion. And over time, we have a target to decarbonize our portfolio. So that's what we're working to. But it's a question of decades that we're looking at. It's not something that's going to happen in the 5 or 10 years. So I think this ratio will need to gradually shift towards the low carbon side. But I don't see that fossil investment would go to zero in that. That's not doing a service to the world either.
And Olivia, Apollo has a pretty big checkbook. I think you told me backstage, was it 59 billion in clean energy investments since 2022? Talk us through how you're currently looking at that investment strategy, and sitting here today, where are the most attractive opportunities?
Absolutely. So in 2022, we set a target for ourselves of 50 billion by the end of 2027. So we gave ourselves 5 years, and we thought during that period of time, we were going to try and invest 50 billion into low carbon, energy transition, decarbonization, et cetera. And we were pleased that we put 59 billion to work, in effectively 3 years. And that was, to your earlier question, that was just finding good deals, right? We do have some dedicated pools of capital around the transition, but most of that just went into funds that were looking for good risk return. So we are seeing a tremendous amount of opportunities there. Some areas we're focused on right now, grids, very, very topical, whether it's the US or Europe. There's a tremendous amount of capital that is needed to invest in these areas. You've got tremendous amount of power growth in the US. The last several decades, we were growing at sort of 1%. Now we're growing at sort of 3 to 4% a year. So you really have this sort of voracious need for power in many geographies, and we're looking at areas to invest in. We think that private capital is a really great fit for these. As we think about the time horizon under which we can invest with private capital, a lot of these projects, 10, 20 years, our capital's a really good fit for that. Versus some other pools of capital that are sort of shorter duration. So really looking for ways in which we can create bespoke, tailored solutions to meet those needs.
And Karen, you may have a view on this too, but either Karen or Olivia, you mentioned grids, infrastructure. Is it easier right now to talk about infrastructure, energy security than sustainability, green, climate?
I think it's always been a trilemma. I think for the last 5, 6 years, I think everyone here always thought about the balance of energy sustainability versus security versus affordability. And that's why we talked about the business case being so important, which is why renewables and storage are getting such strong business investment case, because it is cheap and it is competitive and it is getting better and getting cheaper and more efficient. So when I think about that, it really is just sort of where you can actually find the good investment opportunity, where the dollars actually go. I think, frankly, there's tons of things to think about when you think about the AI evolution, the power mix, and Olivia talked about power grid and power capacity needs to grow more significantly, 3 to 4%, maybe some analysis even say 6 to 7%. How do you do that? How do you actually have the global power grid, right, that actually needs to reduce waste and improve efficiency? Maybe that's one. You kind of deploy all the excess capacity, but you've got to have energy, all energy forms. You got to have renewable energy that's competitive, but they are intermittent, and the battery storage isn't there to solve all the problems that we see, and AI needs firm power 24/7. So the reliability issue becomes very important, but you can't just invest in all of that and drive up, power prices, electricity prices. That's a huge component of the consumer's consumption. So we have to make sure we really pay attention to investing technology that are cheap and affordable, but also secure and firm.
I agree. I mean, when we talk to our data center management teams and you ask what they're permitting for, it's really all of the above. They're permitting solar plus batteries, they're permitting gas, they're permitting nuclear. Like this is really, we talk a lot about the transition. It's an energy expansion, it's an energy addition. I mean, we're really trying to just figure out how we accelerate power in the US and globally.
Does that involve coal?
Less coal.
I want to talk about China. Karen mentioned it earlier. For the most part, it is Chinese investment that has driven price reductions for technologies like solar, to the point where they're competitive and indeed often significantly cheaper than other alternatives. But China is now trying to get a grip on price wars within its manufacturing sector. And of course, there's a huge geopolitical element to this as well. So Mallika, you do a lot of work with China's State Council. What do you see as sort of appetite within China and China's ongoing role in underwriting a global energy transition?
Yeah, so I mean, let's get one thing straight. The overcapacity in China, which they export, is a good news for everyone else because it does make the panels cheaper. It makes the EVs cheaper.
But if there's less willingness in China to sort of keep that flow going, like if they're trying to actually cut down on overcapacity, does that dynamic change?
I think they've committed to the low carbon as their new sort of growth driver, if you like. And if you look at the growth for last year, 2024, the amount of growth they had, 40% of that came from what they call the new three industries, which is EVs, batteries, and solar panels. So I don't see that changing. They still see that as being the future driver of growth. They see a big global market for those technologies, and they want to be the market leader there. I think what you're seeing now is a recalibration and a reorganization of the industry, a rationalization, if you like, maybe they got ahead of themselves. Now you need to draw back some of that capacity. We've seen that with automakers in all parts of the world. It's not just a Chinese story in that context. So I think that's just part of industry dynamics. As an economist, you see those cycles quite a lot. But the long term, I think structurally, I don't see a change in what they would see as their offer to the world that benefits their economy too.
And we are lucky to have major players from both banking and private credit on this panel today. Olivia, you already mentioned the sort of longer duration that private credit can offer, but do you think that's the sort of the main sales pitch for private credit in this space?
It's certainly one of them. I'd say the duration combined with the bespoke nature of it is really where we've focused our story over the last few years. I will say we partner a lot with banks. And I think there's often this view, is it private credit, is it banks, how do they work together? We're actually great partners. I think we've had tremendous success with sourcing relationships with banks as well. So I do really think it's a nice partnership and it's very symbiotic.
Care to take that from the bank side?
Sure. I think Olivia talked about the collaboration. I think it's important to put into context. First of all, I agree. Secondly, is if you think about the global fixed income and global equity market, just the public market, it's about $270 trillion. You think about the private markets between VC, private equity, and private credit, that's about 13. That's about 5% of the global public market. And as banks, when we think about our role, our main role is to connect the demand and supply of capital. We aren't really supposed to be long-term asset owners. It isn't our money, it's our depositors' money. We're supposed to be there to bridge to something, to bridge to securitization, bridge to a takeout, to do construction so someone else can take the operating asset. We're supposed to be there to help enable merger and acquisitions. You heard about the M&A boom that we're seeing and will continue to see, sounds like. And we're supposed to bring companies to public or bring them private if that suits them. So I think our job is to advise, to structure, to really connect that supply and demand. And frankly, I think private credit, given that they're not regulated by banking regulation, which really tightened post the financial crisis, are there to take a longer duration capital, patient capital, but they can also take, frankly, riskier part of the capital structure. So we always do A/B tranches. If you hear those words, or we're doing the seniors, we're doing the mezz, it's because there is a pocket for risk returns that are seeking the right home.
And Bank of America has a $1.5 trillion sustainable financing goal by 2030. I think you set that in 2021. How are you tracking towards that?
4.5 years in, and just like Olivia's firm, and we actually are about a year ahead of pace. So about $150 billion ahead of pace. Again, that's not because we're doing great, it's because our clients are doing great, and all of these investments that we saw, the business case that we talked about, are actually getting dollars. And we are underwriting, we are distributing, we're putting on the balance sheet, we're bridging. So we're doing a lot of those investments and ahead of the pace. But I do think there are some headwinds that we talked about policy, we talked about stability. I think permitting reform needs to happen everywhere globally faster. We need to be really smart about energy efficiency and making the grids more resilient. A lot of those investments are good investments that we have to make. So we're optimistic. We'll finish the goal early, but I think it's not without challenges and headwinds.
And that point on challenges, Olivia, where are you seeing some stress?
So it's funny, over the last couple of years, we've had so much in the US on the policy side that in some ways has looked very, very interesting. In other ways has been a challenge. I'll give you an example. You know, when the IRA was announced, I think people got really excited initially, but then there was some time to figure out exactly how it would play out. And so you saw like a real freeze in investment. And then, you know, post the election in the US last year with the OBBBA, you also saw people sort of pausing, trying to figure out how that was going to work. You combine that with tariffs, with the executive order, and there's just been a lot of start and stop in the U.S. market. And the impact is that I think that's been very tough on some smaller businesses. We are certainly seeing some distress around renewable power for the first time in a while, actually. I mean, it was a sector that was really up and to the right for so long. And now really this uncertainty, this timing, the bottlenecks, you know, have all created a situation where there is a need for capital. And I think there are going to be some companies that won't make it.
And so far we've focused most of this conversation on mature technologies, where the money is going, as Karen outlined earlier. But I want to ask about that piece, that less established sort of emerging technologies piece. I guess how do we get more financing directed toward that sector? And B, if there's any technologies that you see as especially exciting. Maybe Mallika, we'll start with you, because you do scenarios that look at all of this, right?
Yeah, so we do, so shell scenarios obviously have been around for a long time, and they help, and they're a great PR tool, but they also actually help our internal thinking. So a lot of this, the technology story, I think we sort of see these, the electricity, renewable side, sort of getting its momentum, sort of getting marketed and sort of moving in that direction. It's the hard to abates, hard to electrifies, rather, that we spend a lot of time worried about, because those technologies, which are mainly fuels and molecules, low carbon molecules, are really further away from sort of commercial readiness, if you like. And the question is, what kind of funding or financing does that need to get that to the stage where it becomes investable? And I think that sort of is where we are sort of looking and wondering where that comes from. When you look at the venture capital, a lot of that ends up going into the electricity grids, EVs, which is sort of a little bit contrary to where I would expect venture capital to go. You think they would be in the slightly more risky end of that spectrum. So that to me is a real concern, because there is a need to commercialize that. And if you look at government sort of balances and funding, that's strained currently in the advanced economies that have tended to fund a lot of these pre-commercial developments. So that is a real conundrum as to where is that sort of slug of funding to get these technologies progressed. Where is that going to come from?
For us, given the type of capital we deploy, we've been very focused on mature technologies. Spent a lot of time around solar, a lot of time around batteries, wind. The one area that I'd love to see more development in is long duration batteries. We are still dealing with a relatively short cycle on batteries. I think there's a tremendous role for batteries in really balancing some of these markets, particularly ones where you have more and more intermittent power. I mean, what's going on in Spain right now is a really interesting example of where batteries could be very, very beneficial. But the timing, the duration of these batteries is still quite short today. So that's something I really hope will develop better longer term.
And then I guess maybe we'll finish it up by talking about, last week was New York Climate Week, and Anga, as you mentioned, the technology such as advanced geothermal and nuclear, which also includes SMR and fusion. As well as
the technologies that are popular with the administration.
Yes, yes. I think those two technologies are definitely getting a lot of attention. Many panels on that. DOE is doing interesting work in the U.S. on DOE land with DOE permitting on small modular reactor. with very aggressive timeline. 12 months in criticality. That just means they can turn the switch on and produce electrons. So that is a timeline people never heard of. Fusion, there are a few companies that are making tremendous progress, and if you're not in the power space, and people always say fusion is 10 years away, I actually think this time around they're really 5 to 10 years away. So there are really promising progress there, but it doesn't solve the AI power need for the next 3 to 5 years. But look, AI is probably a transformative event that will last many, many decades, and therefore we hope those emerging technologies will become more scalable, more cost competitive in 5 to 10 years.
And I'm going to sneak one more question in under the wire because we're just running out of time. Karen, it's for you. What difference does the collapse of Net Zero Banking Alliance make to this conversation?
Look, we're still very committed to net zero before 2050. Our $1.5 trillion goal is a board level goal that we report to, we take seriously, we disclose. We haven't changed any commitment. Bank of America has been around for 125 years. We don't plan for 4 or 6 year cycles. And Net Zero Banking Alliance, look, it's part of the net zero, GFANs and asset owners, asset managers. Everyone used the alliance to do something really, really important, which is to baseline everyone's goal and make sure everyone has the right taxonomy, everyone has the right intensity reduction goal on carbon. And I think that has served its purpose. So now we continue to work with our clients and we march forward.